Hey there, have you ever looked at a price tag and just wondered, what's the real story behind that number? Well, today, we're going to peel back that little sticker and dive into the surprisingly dramatic world of inventory accounting. Seriously, so let's get into it. At the end of the day, all of this comes down to one simple-sounding question. What is a company's stuff really worth? And as you're about to see, the answer is way more complicated and honestly way more interesting than you'd think. So here's our roadmap. We're basically going to follow the life of an item. We'll start with what inventory even is and figure out its true cost. Then we'll get into the golden rule for valuing it, how we track which one sold, and what happens if it all goes up in smoke. And finally, we'll see why this one number is so incredibly important for a company. All right, let's start at the beginning. What exactly is inventory? Because it's not just a bunch of boxes sitting in a warehouse. Nope, it's one of the most vital assets a company has on its books. The official definition is pretty straightforward. Inventory is basically any asset a company is holding onto that's either ready to be sold, in the middle of being made, or is going to be used up to create something else. And this stuff really comes in three flavors. Think about making a sneaker, right? You start with your raw materials, the leather, the rubber. As you start putting it together, it becomes work in progress. And once it's all laced up, in a box, ready to go, that's a finished good. All three of those are inventory. Okay, so now we know what it is, but how much is it worth when we first get it? Calculating its initial cost is a huge deal, and trust me, it's about a lot more than what you paid for it. The true cost includes pretty much everything it took to get that item ready to sell and in the right place. So you start with the purchase price, of course, but then you add in any import duties, shipping fees, the wages of the person who built it, and even a little piece of the factory's electric bill. Now here's what's just as important, what's not included. If there was a big mistake on the production line that wasted materials, that's out. The cost to just store it in a warehouse, out. The CEO's salary, definitely out. The marketing budget, out. All those things are just expenses for the month. They don't get baked into the value of the inventory itself.
So, you've done all the math to find the cost. Great, but is that what the inventory is actually worth today? Well, this brings us to the single most important rule in all of inventory accounting. It's a massive reality check.
And this is the golden rule. Okay, inventory has to be valued at the lower of two numbers. What you paid for it, that's the cost, or what you can actually get for it right now, which we call net realizable value. It's really just a rule of, honesty. It stops companies from pretending their assets are worth more than they really are. And just so we're all on the same page, net realizable value, or NRV, is simply the estimated selling price, minus any last-minute cost to finish the product and any costs to actually sell it, like sales commissions. It's what you'd really walk away with.
So why would what you can get for something be lower than what you paid? Oh, for all sorts of reasons. Maybe this stuff got damaged. Maybe it's last season's iPhone model and nobody wants it anymore. Or maybe prices for that item just fell across the entire market. This rule forces companies to face that reality and write down the value.
Okay, now here's where it gets a little bit like a shell game. Let's say a company buys a bunch of identical sneakers, but they buy one batch for $50 and a month later another batch for $60. When they sell a pair, which one did they sell? The cheap one or the expensive one? Believe it or not, the answer completely changes their profits. So, accountants have two main ways to handle this. The first is called FIFO, which stands for first in, first out. It just assumes the first things you bought are the first things you sell. The other popular method is weighted average, which kind of mushes the costs of all the identical items together to get one single average price. Let's just walk through FIFO. Picture a conveyor belt. The first sneakers on the belt cost $50. The next batch on the belt cost $60. So when you sell 120 pairs, FIFO just assumes you sold all 100 of those first cheaper $50 ones and then 20 of the more expensive $60 ones. Simple as that. It means the inventory you have left is valued at that newer, higher price. All right, let's talk about a total disaster. Imagine a fire, a flood, and all of your inventory is just gone. How on earth do you figure out what it was worth for your insurance claim? Well, luckily, accounting has a really logical way to piece it back together. So, how in the world do you solve this puzzle? It's actually a pretty clever three-step process. First, you dig into your old records and find your normal profit margin. Then, you use that percentage to estimate the cost of everything you sold this year before the disaster. And the last step, it's just simple math. You take what you started with, add what you bought, and subtract the estimated cost of what you sold. Boom! Whatever's left, that's the value of what you lost. So, we've defined it, we've costed it, we've valued it, tracked it, and we've even figured out what to do when it's destroyed. But why? Why does this single number on a financial report matter so much? Here's the bottom line. Getting this right is about telling the truth. It stops a company from pretending its warehouse full of forgotten gadgets is still worth a gold mine. This one number gives investors, banks, and everyone else a real, honest picture of how healthy the business actually is. And that wraps it up. You now know the fundamental rules behind the story of every single price tag. Which, of course, leads to one last, very interesting question. Now that you know the rules, how might a company try to bend them? Something to think about. Thanks for tuning in.